Nothing that one of the great value investors would ever own. Will Nasgovitz with us from Milwaukee, Heartland Value Fund. Great to have you here.
Thanks for having us.
Where's value in the market right now? You wake up in the morning, you look at all the hype about you don't own LinkedIn, do you?
No.
You don't own LinkedIn.
No, we don't.
Where's the anti-LinkedIn right now? Where's the value right now?
Well, at Heartland, we're focused on identifying high-quality, out-of-favor companies that trade at attractive valuations, whether it's on a price-to-earnings or price-to-cash flow basis, but also have those great balance sheets. And frankly, we're contrarians at heart, and we zig when others zag, and we think that's important to create long-term wealth. So an area of a market that we're starting to find value in would be in the building product side for home construction, believe it or not, or some of the do-it-yourself home retailers that service that same market.
What's a value trap? We all know you can find value and you can stay whether it's Heartland or the other great value investors. How do you define that mistake that's called a value trap?
Well, sure. We're 2 years removed from the market low in March of 2009, so we've had a substantial move off the lows, but hundreds of companies are trading below their historical valuation ranges, whether it's on a PE, price to cash, or price to book. So we want to find those companies that have great valuations and great balance sheets, but we want that catalyst for recognition. That helps us, Tom, identify those companies that hopefully will not be that value trap. So a catalyst could be a new management team, a new product line, for instance, or something that's going on in the industry like pricing power, for instance.
Let's bring up one of our long-term view charts. I love this chart, folks. I call it the Ibbotson chart in honor of the great researchers of a number of years ago. The Dow across 9 decades, and you can see logarithmic slope matters. Up we go flat. Up we go flat again. What's it going to take, Will, to get the Dow as a representation of value to get it going again? What do you need to really begin to see equities come back?
Well, I think it's actually it's an attractive time right now. The sentiment across the individual investor or even the institutional investors is in a very bearish terrain right now, and that's attractive to us. Valuations seem reasonable. There's a heck of a lot of money floating around the world today, so M&A is picking up from the strategic and financial buyers. So I think this is the time that you want to remain invested. I think it comes down to that bottoms-up stock picking, which is what we do at Heartland.
What's the distinction between Lowe's and Home Depot? You like Lowe's. You consider the non-construction that's out there now. We're going to see construction. Why Lowe's over the orange box?
Well, I think the orange box has done a great job. I think they've tackled some of the low-hanging fruit, very well. We like Lowe's because it trades at a discount to Home Depot, about a point cheaper on a PE or EV to EBITDA basis. We think their balance sheet might be in a little bit better shape. We think they have the potential to raise their dividend. They've been very aggressive on the stock buyback as well. And then, specific-wise, we think there is pent-up demand, whether it's for Lowe's or Home Depot, for consumers like you and I to upgrade our homes, or some of these individuals that are buying some of these foreclosed properties to refurbish these homes. So we think that the same-store sales comparisons for someone like Lowe's are very easy, and we think that's the type of environment. And we'll also I want to bring up sentiment here as well. There's only 11 buys and 13 holds on Home Depot, or excuse me, on Lowe's, versus 16 buys on Home Depot and 13 holds. So it's more out of favor. That's the type of names that we like to own. We like to own those low expectation stocks.
Did you own Timberland?
No, we did not own Timberland, no.
Okay, well, here's a note. Kate McShane over at Citigroup. This is, folks, as a window into how the pros talk. You heard Will talk about enterprise value to EBITDA there. If VFC is able to raise TBL's operating profit margin to 15%, it would imply a 7 to 8x EV/EBITDA multiple. Okay, that's Greek to me. Well, actually, it's not. But it's a massive jargon. That's like a jargon overload. That's so far past jargon alert. But, Will, when you look at that, and that's a perfect, how do you fold M&A into value investing? I mean, it's got to be a benefit, right?
Well, sure. And I think of the numbers on a trailing 12-month basis. I think they acquired them for about 10 or 11 times. So we'll certainly incorporate that type of valuation for some other companies that would compete against Timberland, for instance. So when we're trying to value a company, what is the business worth? And we're going to try to look out in a normalized operating environment. And we'll certainly include some of these figures like we saw today with Timberland and their recent takeout.
Will, I want to ask you this, and I say it with all good spirit. You're from Milwaukee. It's conservative National League Baseball. We all know the story. Is Apple a value stock? Bring up the chart of Apple. It's a moonshot. Why should I be in boring value stocks if I can find a growth machine like Apple?
Well, I think I think Apple's a great company, and I don't know what it trades on a multiple of earnings. It might be 13 or 15 times, which is not that expensive, right, for one of the world's best companies out there. But it comes down to risk and reward. So we're trying to identify those companies that are trading at the low ends of their historical valuation ranges, that have those rock-solid balance sheets, and that catalyst for recognition that is not recognized by the broader market. And that's why the Select Value Fund, which I co-manage, has outpaced the broader market and our peers over a 3, 5, and 10-year time period. So that's why you want to be a value investor. You want to identify those names that have low expectations and can really create money for your shareholders over the long term.
Is there emerging market value right now? Is there emerging market value, Will?
Well, I think we're focused principally on domestic-oriented stocks at Heartland, and particularly in the Select Value Fund. I think that in terms of opportunities in emerging markets, I think there are. I think a lot of those central banks are tightening, so I'd be cautious in terms of the outlook in the near term there. But it'd be tough for me to really make that call since we don't focus on those markets.
I don't see a lot of financials. We've heard that recently from a lot of people ignoring them. Tom Brown in a little bit with Bank of America. Right. Where are you on the banks?
We were massively underweight the financials starting in the fourth quarter of 2007. Just didn't feel comfortable. Let's just, as it relates to commercial banks or regional banks, they're trading around 2.5, 3 times book. We were concerned about their financial risk. We started to get back in that game into the 2008, 2009 timeframe. We're about 20% allocated to financials right now. It has hurt our overall performance on a year-to-date basis. It's been one of the poorer performing groups in the space, but we think credit has peaked. So we tend to be early sometimes, but we think there's a lot of value in the financial space.
Let's leave it there. Will, thank you so much. Break exclusive. He actually said that he's underperformed in financials. Will Nasgovitz with Heartland Select Value Fund.